If we stop pretending for 5 minutes, the story is simple. America runs on borrowed money, and the world used to buy that story without blinking. That habit is fading. If demand thins at the wrong time, the cost to run the country jumps and the pressure lands on households, businesses, and cities fast. For years, the U.S. could roll debt on autopilot. New bonds went out, buyers stepped in, and rates stayed friendly. Inflation broke that. When prices run hotter than fixed coupons, lenders lose and they remember it. Now they want more to lend again, especially for longer terms, and they're quicker to walk when the offer looks weak. Buyers still show up, but on shorter leashes. Treasury bills clear because the time risk is small. The trouble is the longer bonds. When the 10-year and 30-year Treasury bonds need a richer yield to move, the entire price of money resets higher. That is, mortgages, business loans, state budgets, and every plan that assumes financing stays easy. It's not a theory. It shows up in monthly payments, canceled projects, and hiring freezes. Here's the part that decides the next few months: Treasury auctions and short-term funding. Watch both. If you see a run of soft, long-dated sales and funding stress at the same time, the system is saying pay more or slow down. That's the real Sell America signal. It's not culture war. It's capital voting with bids and balance sheets. What does a soft auction look like in plain English? Fewer buyers chase the size, the government pays up, and dealers are left holding more than they want. You'll see that as weaker bid to cover, bigger tails, and heavier primary dealer take. You don't need to love those terms. Just know this: if results slip in a streak, the price of time goes up and the fallout shows up in your life. What does funding stress look like? The safest collateral in the system is government debt. In stress, big players hoard the cleanest paper, repo gets tight, and short rates nudge higher even if the Fed is standing still. That quietly drains risk-taking. Credit standards tighten. Deals slip. You won't get a breaking news banner for it, but you'll feel it in approvals, terms, and speed. Sell America isn't an insult, it's a negotiation. If the story looks sloppy, money shortens duration, demands more yield, and steps back from risk. You'll see foreign reserve managers lighten up on longer notes. You'll see funds hunt the front end. You'll see banks and insurers protect capital instead of stretching. It's not about slogans, it's about price and time. So why should any of this keep you watching? Because this is the earliest read on whether the next year is smooth or rough for normal people. When auctions run clean and funding is calm, rates can drift lower and plans get easier. When auctions slip and funding tightens, every lever you pull costs more, and you don't get to vote on it. Knowing which path we're on before it hits headlines is the edge. Here's how to read the next month like a pro without being one. 1. Check auction results on the days they hit. If long issues keep stopping worse than the market expected, that's a yellow light. 2. Watch whether dealers keep being forced to absorb more than usual. If yes, that's another yellow light. 3. Watch short-term funding prints. If repo and other short rates pop on stress days, that's a yellow light turning orange. What are the real-world hits if those lights turn red? Mortgage quotes jump and stay sticky. Small businesses with variable loans see payments reset. Cities delay work because interest eats the benefit. Hiring slows because CFOs won't add costs into a tightening cycle. Stocks don't need to crash for this to hurt. The pain shows up in financing and timing. What could calm this down quickly? A credible plan that grows capacity and lowers the need to spray debt at problems. Faster permits for energy, grid, ports, and key corridors. Clean timelines for big projects so money can commit without death by delay. Training that lines up with jobs that exist. A tax code that rewards building real output, not games. None of that is flashy. All of it lowers risk and signal noise. What would make it worse? Bigger borrowing with no change in priorities? Surprise shifts in issuance that flood the wrong part of the curve? Political theater that tells buyers nothing will change? A run of sloppy auctions? A few squeezes in funding? That's how you get a slow grind that people feel even if cable news says everything's fine. Let's talk about positioning without hype. This isn't personal financial advice, but there are basic rules that help in tight money. Keep some flexibility so you don't need to borrow at the worst time. Avoid over-levered bets that only work if rates fall. If you can fix a rate that matters to your life or business and the math works, don't overthink it. If you hold cash, know why you hold it and what would make you deploy it. if you invest size positions so a volatility bump doesn't force you to sell in a hurry. What should leaders actually do right now? Publish a clear refunding schedule that the street can plan around. Balance bills, notes, bonds, and inflation. Link supply to match demand. Use buybacks to smooth liquidity and old issues if needed. Kill deadweight delays that block high-impact projects. Tell the truth about trade-offs and move first on the easy wins that build trust. Markets don't need speeches. They need signals that line up with action. 2 paths from here. Path 1, auction stabilize. Funding stays calm and longer rates ease as capacity work shows up. Households get a break, projects restart, and the Sell America talk cools. Path 2, week-long auctions stack up. Funding tightens and leaders dodge the hard choices. Mortgages stay high, credit tightens, and everyone pays more for waiting. You don't need a PhD to tell which path we're on. You just need to look on the right days. If you felt like the last few months were harder to plan, you're not imagining it. The rollover bill is real, and buyers don't love long promises right now. That can change, but it won't change because someone says a nice line on TV. It changes when there's less guessing about supply, faster progress on real projects, and proof that borrowed dollars are backing things that produce. Capital respects that. It shows up and it stops charging the uncertainty tax. Before we close, here's the simple checklist you can run from a phone. Auction day. Check results on long issues. If they're soft in a streak yellow light. Funding. Check if short rates jump when markets wobble. If yes, yellow light. Policy. Watch for concrete wins on permits, timelines, buybacks, and project starts. If those show up, lights turn green faster than people think. Who pulls back first when risk rises? Foreign reserve managers shoring what they buy. Big funds prefer bills so they can roll. Banks and insurers defend capital and avoid adding long duration at awkward levels. You'll feel it as higher long yields and tighter credit terms until policy and execution improve. Make a simple weekly routine. On refunding weeks, set reminders for 3-year, 10-year, and 30-year results. If the stop keeps coming worse than expected and dealers take heavy loads, mark it down. After stress days, glance at short funding prints. If they pop and stay sticky, mark it down. 2 marks in a row is a trend worth respecting. This story isn't about rooting for failure or doom. It's about reading the signals that decide your cost before they hit your wallet. If we stop pretending for 5 minutes and look at the screen together, the path is obvious. Either earn trust and borrow cheaper, or drift and pay more for the same road. That choice isn't abstract. It reaches rent, payroll, and the date your project breaks ground. If you want more straight talk like this before the crowd wakes up, subscribe right now and stay ahead of the next move.